Hello, and a very warm welcome back to Beyond the Backtest, the systematic trader's journey. It's a pleasure to have you with us for episode 3, which we're calling Choosing Your Arena, the unique character of markets. Now, it's incredibly tempting, isn't it, to dive straight into crafting the perfect trading strategy, tweaking parameters, and optimizing every last detail. But today, we're going to explore why the where you trade is every bit as important as the how. You might find it helpful to think of it this way. You could be a world-class surfer, but if you paddle out into a completely flat, waveless sea, all that skill counts for absolutely nothing. A brilliant trading system is much the same. It needs the raw conditions to perform. What I've learned is that this choice of arena is one of the most foundational decisions we can make. It truly dictates everything that follows. So, let's begin by taking a bird's eye view of this vast universe of markets. I find it incredibly useful to think of each asset class as its own unique ecosystem, with its own distinct rules for survival. You have equities, shares in companies, which are typically traded on centralized exchanges, where institutional players often dominate the flow. Then there's the colossal world of Forex, the currency market, which is a decentralized, over-the-counter affair, primarily driven by macroeconomic data. Venturing further, we find futures, which cover everything from commodities driven by physical supply and demand to stock indices reacting to broad economic sentiment. And of course, there's crypto, the newest ecosystem, very much driven by pure sentiment and technological shifts. Each one of these arenas has a different structure, different inhabitants, and a completely different pulse. Our job is to understand that pulse before we ever place a trade. Now that we have a map of these ecosystems, we must confront what I call the silent killers of alpha: liquidity and transaction costs. For a systematic trader, liquidity is paramount. What I mean by that is simply the ability to execute our trades at or very close to the expected price. This is where we encounter the unavoidable cost of doing business. I tend to break this down into 3 parts: the bid-ask spread, the commission, and the most insidious of all, slippage. That difference between the price you wanted and the price you got. You might find that in a highly liquid market, like a major currency pair, these costs are trivial. But try to apply that same strategy to an obscure penny stock or a new altcoin, and the story changes dramatically. The spread can be a chasm, and slippage can be severe. I've seen strategies that look brilliant on paper, only to have their entire theoretical edge completely eroded by these very real-world costs. It's a foundational check I always run. Can my expected profit per trade survive this friction? If not, the arena is simply unplayable. Beyond the raw costs, what I find truly fascinating is that every market has its own distinct personality, a unique behavioral fingerprint, if you will. I've spent countless hours observing this, and what I've learned is that some arenas, like many commodities, have a strong proclivity to trend. They pick a direction and stick with it. On the other hand, you might find that major currency pairs often exhibit a more mean reverting character, oscillating around a central value. And it goes deeper still. I like to think in terms of volatility regimes. Some markets are perpetually choppy and noisy, while others can be calm for months, only to erupt in an explosive move. The real art here, the crucial piece of the puzzle, is matching the logic of your system to the dominant personality of the market you've chosen. It's a question of finding the right dance partner. This idea of a market's personality extends even further, right down to the time of day, particularly in the great global arenas like Forex and futures. What I found to be critically important is understanding that these markets don't just have one personality. They have several, depending on who is at the desk. A classic example I always point to is the Euro-USD pair. You might find that during the Asian trading session, it's often rather subdued, perhaps just moving in a tight range. But then, as London opens and later overlaps with New York, its entire character shifts. Suddenly, there's a surge in liquidity, volatility picks up, and the real moves of the day often unfold. This isn't just a curious observation, it's a vital input for system design. What I do is ensure my system is conscious of these daily rhythms. A strategy that thrives in that high-volume London session might be completely unsuitable for the quieter Asian hours. It's about knowing when the waves are most likely to arrive. Now, if our trading system is the engine, then data is unquestionably its fuel. What I've come to realize, and what I cannot stress enough, is that a systematic strategy is only as robust as the data it was built upon. Sourcing that data, however, can be a real adventure. You might find, for instance, that getting clean, extensive historical data for major equities is relatively straightforward. But should you venture into the wild west of crypto, it's an entirely different story. What I often see there are datasets plagued by gaps from exchange outages, formatting inconsistencies between platforms, and outright errors. It's absolutely critical to be a detective here. What I do is spend a significant amount of time cleaning and validating my data, because I know that a flawed backtest built on poor data is worse than no backtest at all. It gives a false confidence that will almost certainly lead to a failed strategy in the live market. Now, layered on top of all this is something we simply cannot ignore: the regulatory maze. I find it's essential to view the rules of a market as part of its core character, as they directly impact how a strategy can even be implemented. What I do is create a checklist for any new arena. What are the leverage limits? What are the specific margin requirements? For instance, you might find that in US equities, the pattern day trader classification can completely alter your approach to trade frequency if you're below a certain account size. This is worlds away from some more loosely regulated offshore jurisdictions, which might offer more freedom, but this often comes at the price of investor protection. It's a personal calculation I always make, balancing that operational liberty with the safety of a well-policed game. Let's make this tangible with a case study. Imagine we have a simple mean reversion strategy. The idea is to buy dips and sell rallies. Now, let's place it in two different arenas. First, a broad stock index ETF, like the SPY. What I often find here is that mean reversion can be driven by quite structural forces, perhaps institutional rebalancing at the end of the day or a week. It's often a relatively orderly process. Now, let's take that same core logic over to a currency pair like the Australian dollar versus the Japanese yen. Here, the market's personality is entirely different. Mean reversion is frequently driven by swift, emotional shifts in global risk sentiment. So, naturally, the parameters of my system would have to be completely different. A look-back period that works for the steady rhythm of the SPY would likely be useless in the face of AUD-JPY's sharp, sentiment-driven swings. The exit triggers, the volatility filters, everything must be tailored to the arena's unique character. It's the same core idea, but two entirely different games. So, how do we bring all of this together into a practical framework? What I found works best is to create a checklist of critical questions before entering any new arena. The very first question I ask is this: does my strategy's logic truly fit the market's dominant personality? It's a crucial test of compatibility. Next, I am ruthless with the numbers. Can my expected profit per trade survive the friction of all transaction costs? If the answer is no, it's a non-starter. Then I look at the fuel. Is clean, extensive historical data readily available for a robust backtest? I also check for liquidity, but specifically during the times my system will be active. And finally, I consult the rulebook. How will regulations on leverage or position sizing impact my execution? By methodically answering these questions, I can choose my arena with confidence. And so, as we wrap up our discussion, what I hope you take away is that market selection is not a passive choice, but a deeply strategic decision that truly predetermines a strategy's potential for success. What I found, time and again, is that the right arena acts as an amplifier for a good system, while the wrong one almost guarantees its failure. Now that we've carefully considered our playground, the natural question becomes, how do we come up with the games to play? I do hope you'll join us next time for episode 4, The Idea Factory, from observation to alpha, where we'll explore that very art and science of generating new trading ideas. Until then, thank you for listening.
If you find this information useful, we would really appreciate it if you would like and subscribe this channel to help others find us. If there are subjects you would like covered, please add in the comments section and we will include it in future episodes.